Hi, this is Steve Gorin. Welcome to my quarterly webinar. This is on sale of interest in trust. 3 different topics like we always do from my newsletter, and so-called negative capital accounts and the final regulations and transfer for value. Before we begin, I wanted to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We'll try to answer these during the webcast, but if a full answer is needed or we run out of time, then I'll answer it later via email. A copy of today's slide deck, as well as other reference materials, are available in the resource widget. You can also find these materials on our website. We encourage you to download any resources or links you may find useful. You can find additional answers to some common technical issues located in the help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for 1.5 hours of general credit, and in Missouri for 1.8 hours of general credit. We award CLE based on attendance for the entire 90 minutes. From time to time, you'll be required to click a pop-up screen to reflect your continued engagement. Your certificate of attendance will be emailed to you later this afternoon once your attendance has been verified. We value your opinions and really do appreciate your participation in the course. So now going on to the next slide. So we were going to first talk about whether changes to a trust will trigger income tax consequences. And then we're going to spend just a little bit of time on reporting and planning for so-called negative bases in partnership. And then we'll talk about whether the transfer of a life insurance policy will cause the death benefit to be subject to income tax. Next slide. So regarding sales of interest to trust. So interest in trust, I mean. So there's all kinds of things that you can do with trusts. You can divide trusts, you can merge them. A decanting is when you take assets from one trust and pour them into another. And we will talk about the different flavors of decanting. A trust commutation would be when somebody's interest in the trust is bought out. And in some ways, that's like some of the things that are above it, but in other ways, it's not. And we'll go through the distinction to compare a commutation to a mere division. And so we're going to really talk about, like, the first few things are usually not income taxable, and the trust commutation is income taxable. And so then we're going to talk about, well, how do you make the distinction between the income taxable and the non-income taxable items? Because there's been a lot of discussion on this, and I think that that people really have not focused on. They focus on one area or the other, but they don't really kind of try to meld the two ideas together. But we're going to do that here. Let's go to the next slide. So the law on trust divisions, and you can see here that this is referencing in the parenthetical to 2J18A. So in my technical materials, you will find this in 2J18A. The newsletter itself will link you right to the page that contains the beginning of 2J18A. And so all of this is supported by various technical material that's in the newsletter. So just to start off, the very, very fundamental idea, the partition of jointly owned property does not constitute a sale or other disposition when the co-owners of joint property sever the joint interest. So they own the property together, and then they say, okay, I'm taking my half, you take your half. We're going to go and do our own separate ways. Maybe it was like joint tenants with right of survivorship. So we had survivorship interest, and then what we do is we're converting our one half each to tenant in common, so we don't have that survivorship feature. So, and then we can dispose of our separate one half. So splitting it in half like this is not considered to be a sale. Now, of course, when you sell the property or you sell your one half interest in the property, then that would be a sale. And so then when you kind of take it to the next level, what happens when you have a trust? So if you have a trust and it's supposed to divide up, the question is, what are the beneficiaries' entitlements? Is each beneficiary entitled to their pro rata share of each item of property? Or are they simply entitled to one half of the whole, and the trustee has the authority to decide which parts of the whole they get? If you had two beneficiaries and they each get one half, the trustee can pick and choose any kind of asset, and as long as each beneficiary gets one half. So what is the authority for that? And there's a revenue ruling that says that if you don't have the authority to have this pick and choose fractional funding, and each beneficiary is entitled to their pro rata share of each item of property, then if you do have funding that's not one half of each parcel of property to each beneficiary, and instead each just gets half the value, and the trustee just kind of swaps them around, then it has been a deemed distribution. So if you had two equal beneficiaries, each would be deemed to get one half of each parcel of property, and then to have swapped whatever that person did not retain for whatever that person got. So there would be an income tax event for that. So let's go on to the next slide, slide 5. If you have the authority to make non-pro rata distributions, then of course that protects this, just as I mentioned a moment ago. So the Uniform Trust Code recognized that this was a potential trap, and it put that into the default powers. So if you're in a Uniform Trust Code state, then and the state, of course, followed this provision from the uniform law, then that power to do this pick and choose fractional funding, that power is in your state law. And so you can have it in your trust agreement or in your state law. Uniform Trust Code, we know it's in there. Other states, we just have to go and check your state law if it's not in your trust agreement. So this regulation here, 1.1001-1H, basically says anytime you have a trust severance, then it's protected from income tax, as long as you have the authority to make the non-pro rata distributions. So what's the definition of severance? Well, when you go into the regulation itself, the regulation refers to some generation skipping transfer regulations relating to trust severances. So there's a cross-reference to severance. And then in the examples to the regulation, basically, before I get into the examples, what that regulation says is that you can have various types of some severances. And some severances are qualified severances, which qualify for easier administrative GST treatment. And some severances do not. But then they have a whole list of examples. These are severances. And some are qualified severances and some are not. And the 1.1001-8 says that we're going to protect severances whether they're qualified severances or not. So then you go in to the regulations they cross-reference, and there's a bunch of regulations in there, and my materials go into this and show you what this is. There's actually an example of a severance that is a commutation of a trust. So they call it a severance, and they say it's a commutation, and they say it doesn't qualify for the favorable GST treatment, but they refer to it as a severance. So there's an implication by that a commutation is a severance, at least viewed as a severance under the GST regs, and therefore perhaps it may be viewed as a severance for this regulation, which would make a commutation to be non-taxable. So if you want to take the cross-reference to the GST regs to the nth degree, you could find authority to suggest that a commutation is not income taxable. And there are some people who have seized on this, and they stop their analysis there. So we're going to go on and talk more about divisions, and then we're going to wrap back around to the law on commutations and then the interaction between these two regs. All right, so also on the slide, there's a recent letter ruling that provides division is not income taxable, and it was not a Code Section 661 distribution. So what does that mean? So when a trust makes a distribution to a beneficiary, the distribution to the beneficiary will carry out the trust distributable net income. And distributable net income is generally the trust taxable income before you consider certain adjustments. And then what you do is you're basically dividing this distributable net income to the extent that it gets distributed to the beneficiary. Then there's a K1 that goes to the beneficiary, and it's taxable to the beneficiary. To the extent that the trust retains distributable net income, then with some adjustments, that becomes the taxable income on which the trust is taxed. So all the trust income is divided between what the trust retains and is taxed on versus what the trust distributes out to a beneficiary and the beneficiary gets taxed on. Now let's suppose you divide a trust and the trust that got split off has assets that are considered for distribution purposes to exceed the amount of the D&I. So then the issue is, well, does that split off trust automatically get tagged with all the income, all the D&I, because it got assets, and is it kind of like a beneficiary that receives assets? And so that letter ruling said, no, it's not. This is a trust division. It's not a distribution of beneficiary. We are not going to carry out the D&I to that trust. So that's important to try to figure out, well, what is the true consequence of that trust division? And so not only was the division not an exchange of the beneficial interest, it also didn't carry out income to the divided trust, to the split off trust. Okay, let's go on to the next slide. Now, trust mergers, there really couldn't be an exchange of interest, because what you're doing is you have your beneficial interest from trust 1, your beneficial interest from trust 2, and those beneficial interests they get combined, they get mushed together, and then you just have one big happy trust. So you're keeping them intact. There's no exchange. Now, there is an analogy that can potentially provide tax in another setting. So, like if you had two partnerships and they merged together and they somehow diversified by doing that, then there may be some kind of exchange going on. But that's in the business context of a partnership. And here we're just talking about a merger of trusts. So there's a difference between a merger of trusts and a merger of partnerships. Don't ask me to explain it. I just know there is. All right, let's go on to the next slide. So now we'll go into decanting, which is pouring from the first trust to the second trust. So now decanting can take on many flavors. So sometimes in decanting, let me just back up. What is decanting? So decanting has its roots in common law. There was a Florida case over 100 years ago, and that case said that the trustee could make distributions for any reason to the beneficiary. The trustee was also able to make a distribution for the benefit of the beneficiary. Therefore, the trustee was able to distribute from the existing trust to a new trust for the benefit of the beneficiary. So that's where decanting has its origins, is in that case. So it's really an exercise of the authority to make distributions. So what happens is that sometimes people will decant the entire trust, or they may decant part of the trust. The decanting may have different reasons. So sometimes they're decanting to create the new trust because they just don't like the trustee provisions. And so it really is the equivalent to like rewriting the trustee provisions or other administrative provisions. But other cases, they may be wanting to change the dispositive provisions. So if you're going from one trust to another and you decant the entire trust and you just change the administrative provisions and you're not changing any beneficial interest at all, then the new trust tends to be treated as a mere continuation of the old trust. Now, there's some private letter rulings out there. The IRS, a number of years ago, put out a notice saying, we're looking into providing some guidance on this animal called decanting. Will people please comment? ACTEC put comments in. Other people put comments in. And it's been a long time, and the government has issued no guidance at all on that. So we don't really know we don't really have an official position that anybody can rely on. But one of the issues is that I hear that somebody said that there's an echo. We do have our technical people working on it, so we apologize for that. Okay, so if you are just changing the administrative provisions and not the beneficial interest, and you're doing the whole trust, that's just going to be a continuation. You can use the same tax ID. Generally, that's what we would do. Now, if you have an S corporation, I would tend to actually go and get a new tax ID because if you have an electing small business trust election in place, because I don't want the IRS to come back and argue you have a new trust and you need to get a new electing small business trust. So even though there is some very substantial support to just treating it as a continuation, if you have a tax election that needs to be made each time you transfer assets to a trust, I would just go ahead and get the new tax ID generally and do the new election. So the Uniform Decanting Act recognized, hey, if you're just going to pour the entire trust into a new one, and then you have to retitle all the assets, that seems kind of silly. What we really have going on is the trustees amending the trust. So the Uniform Decanting Act says that if you're authorized to decant, you can do an amendment instead of a distribution. Now, there are only a few states who've adopted that act so far, but we're hoping there'll be a lot more adoptions and people can do an amendment instead of a distribution. And that can be very important if you have a qualified subchapter S trust. A qualified subchapter S trust is a type of irrevocable trust that can hold S corporation stock. And the rules for such a trust say that while that election is in place, the beneficiary has to receive all the income. And whether or not that election is in place, during the beneficiary's life, the beneficiary is the only one who can receive a distribution of income. Distribution of principal. So it's really income or principal. But the bottom line is, if all principal distributions have to be made to the beneficiary, and the trustee wants to decant, so decanting would generally be viewed as a distribution of the principal to a new trust. So query whether decanting would be considered to be a distribution of principal to somebody other than the beneficiary, and therefore would violate the QSST rules. So I would try to avoid decanting or attempting to decant a QSST, and I would try to do an amendment without doing a distribution. So that the Uniform Decanting Act will be very helpful in trying to make us feel good about our decantings of QSSTs, because it'll allow us to just do an amendment without having to worry about whether we've made a distribution that really is not allowed by the QSST rules. So what if you do a decanting and instead of just changing your administrative issues, you change beneficial interests? So what happens is, so you have an initial trust, and then you pour it into a new trust, and suppose that the beneficiary is a beneficiary of both trusts. So how do you measure, if that beneficiary's trust got changed at all, how do you measure the impact of that change? Well, if that person's beneficial interest got reduced, then and they have an interest in the continuing trust, then the entire beneficial interest that was deemed given to that trust is a gift without a reduction for that gift, unless what that beneficiary retained qualifies under Code Section 2702 as retained interest. So think about a qualified annuity interest, like a grant might be, or qualified, or a unit trust interest, like a charitable made or unit trust type of thing. So if you have an annuity or a unit trust interest, then you can take credit for that portion being retained. But if you think of all the bells and whistles, what if it's just a purely discretionary trust, and you're simply changing the beneficiary's discretion, like maybe there's a different standard for distributions to the beneficiary or something like that, then the beneficiary doesn't have anything that we can count under 2702, and there may have been a gift of the entire beneficial interest into a trust. Now, if you decant only part of the trust over to a new trust, then we would just look to see, well, what part of that trust was a beneficiary's beneficial interest. I mean, maybe if you decanted a third of the trust over to the new trust, then maybe that was a gift of a third of the beneficiary's beneficial interest. There's really no law on this that really kind of gives us concrete examples on it. But I'm very, very concerned about changing the beneficial interest. Now, we'll talk about whether a change in beneficial interest rises to the level of being a commuting. We'll talk about that later. But the other thing that I wanted to point about when you're changing the beneficial interests, that you may want to try to avoid that huge gift from being a taxable gift. So a lot of times what will happen is that when people will, suppose you had the right to, suppose the trust said when the beneficiary reaches 35, they're going to get it outright. And when the beneficiary was 34, the trustee decanted into a trust where the beneficiary does not get an outright distribution. Well, in that case, when the beneficiary didn't sue the trustee, the IRS might argue that the beneficiary had a general power appointment. They had an unlimited right to get the money in just 1 year. And when they didn't sue the trustee, the beneficiary made a gift of that whole amount that would have been distributed at age 35. So that's an argument the IRS might make. And then if the beneficiary's interest in the trust is purely discretionary in the continuing trust, then there's no ascertainable thing that you can count under 2702. There's no annuity or unit trust interest. And so then the beneficiary's made a gift of that entire withdrawal right. Well, what you might do is put in, well, the beneficiary may get distributions during the beneficiary's life, and if the beneficiary has a power of appointment upon death, then that might be a wholly incomplete gift. So a lot of people will say, okay, we're going to do our decanting. It does affect the beneficial rights, but we're going to make it an incomplete gift, so there's no gift tax consequence. And then they stop there with analysis. Well, let's take it one step further. When it's an incomplete gift, then it's going to be included in the beneficiary's estate. Now, if the trust were going to be included in the beneficiary's estate anyway, then no harm, no foul. Do your decanting, don't really worry about the consequences. What if the trust is exempt from GST tax? What if it's grandfathered, a pre-86 trust? Or what if there have been generation skipping transfer exemption, GST exemption have been allocated to it as inclusion ratio 0, is protected from GST tax? On the beneficiary's death, there's not going to be any estate tax or GST tax. Now, all of a sudden, we do our decanting to protect it from being a gift. We make it an incomplete gift. Now it's going to be included in the beneficiary's estate. So we took an asset that was outside the beneficiary's estate, perhaps even perpetually outside of the estate tax system, and by doing this incomplete gift, we've now included it in the beneficiary's estate. So if you did have a lifetime trust that was intended to be discretionary trust and avoid GST tax, you decant it, you somehow change the beneficial interest. If you make that an incomplete gift, then you're going to have issues on estate inclusion regarding whatever that incomplete gift was. So that's an issue to consider. So if you're going to decant and change beneficial interest, if it's an estate that's included in the estate already, then okay. But if the trust was not going to be included in the estate, then you have to think really long and hard about whether there's any way you can avoid making it a gift and therefore having to make it an incomplete gift to avoid gift tax. Okay, let's go on to the next slide. So what is a commutation? A commutation is a trust termination that changes the character of a beneficial interest. And that's not a technical definition. I think that there's more to it than just that. But the idea here is that you're really taking the trust, and it was one trust, you're kind of splitting it apart. Every beneficiary gets cashed out, and they're just receiving the value of their interest, but it's different. So, and a very typical example of a commutation is you have a Q-tip trust for the surviving spouse. That trust has a mandatory income distribution. Then you terminate that trust, and the spouse gets the actuarial value of her interest, and the remaindermen get the actuarial value of their interest. So now the surviving spouse has her interest outright. So this is very different. Her mandatory income interest is different than having all of the principal. And it's different in two ways. One way is that she has more access to it because she could have all that principal totally to spend when before she could spend only the income. The other way that is different is that before she got income on the entire trust. Now she's getting income over only part of the trust. So In some ways, she has a bigger interest because she has all the principal. In other ways, she has a smaller interest in that her income is less every year than it was before. So before, she, suppose she had 3 times the income before the trust got split up. Well, she could spend 3 times as much income without having to worry about her income flow being diminished. Now, if she spent 3 times the income, she'd have just 1 time the income would be the income. The other two thirds would be she'd be dipping into principal. She'd be dipping into principal, and so that diminishes the asset pool that she has, and then her income is going to go down even further next year. And so she'd be having kind of a sinking fund, and she'd eventually run out of money. So having this outright distribution to the spouse is very different than having the lifetime right to the greater trust. So that's a typical example of a commutation. So she's gotten full fair market value, but it's been a material change in the nature of her interest in the trust. And of course, the remainder men, they had a right to get it many, many years in the future. Now they've got the money now. Obviously, it's a change because they can spend the money now where they couldn't before. Okay, so the general rule, and we'll go over exceptions to it, but the general rule is that the life tenant can't use any basis. Now let me back up for a minute. Each interest in the trust, each beneficial in the trust, is actually considered to be a capital asset. And there's a revenue ruling directly on point that says that. So when, in my example, the surviving spouse sells her life interest in the trust, then she has sold a capital asset. Now, the general rule for interest in trust is that you figure out what the actuarial proportion is, and then you multiply that by the basis of the trust interest. And usually people are kind of looking at when the trust got created, what the basis was. That's kind of the way people think of it. Well, there's a special rule that says, as a general rule, and we'll get to the exception, but as a general rule, a life tenant cannot get any basis. So in this example, when the surviving spouse is deemed to have sold her life interest in the trust, 100% of the proceeds are going to be taxed. And they're going to be taxed as capital gain. And if it's been more than a year since the trust was created, that's going to be taxed as long-term capital gain. So her income taxes get messed up. Now, the remainder men, they do get to apply the actuarial value of their interest times the basis. So what happens here with this commutation is we have a destruction of basis occurring. Initially, there was basis in the entire trust, but the surviving spouse doesn't get to use any of her basis, so her basis is destroyed, and there's a taxable event. Let's go on to the next slide. So if the surviving spouse buys out the remainderment of the Q-tip trust, so let's think about that. If the surviving spouse buys out the remainderment, then the remaindermen get to use basis, and so they might not have any gain. Who knows? The surviving spouse winds up getting 100% of the trust minus what she pays. So the equivalent is she's getting cash out for her life estate. The form is different. She's buying their remainder interest out and exchange paying them for the value. But the substance is that she's getting 100% of the trust minus the remainderment value, which is equal to the value of her life estate. So So there's a revenue ruling that says that even though she's buying out the remainderment, we are going to count that as a sale of her interest. And so she's going to get nailed on that. And it's also going to apply Code Section 2519. And Code Section 2519 says that if you transfer any part of your life interest, then you're deemed to have transferred the entire trust. And so the gift tax consequence on that would be that she is deemed to have made a gift of the entire trust when she does that. So the revenue ruling talked about 2519, but there was a letter ruling that talked about a variety of issues, all of the income tax and estate and gift tax consequences to that. So that's an example for surviving spouse. And then there's an example here also for some regulations that if you sell your interest in your charitable remainder trust, your unit trust interest, then how does that get taxed? So, for example, you have somebody who has a unit trust interest, and they're kind of like, I don't want to just keep getting my unit trust every year. I want to get cashed out. And there are people who buy that out. Like one group that sponsors a lot of estate planning seminars is called Sterling, and they can facilitate selling your interest in your trust. And when you sell your term interest and in your unit trust, that's a commutation, so that is a taxable event. Okay, let's go on to the next slide. So when the life tenant buys out the remainderment, we mentioned the remainderment use basis. Now, what property is a life tenant using to buy the remainderment? So let's take a relatively clean transaction. So the trust has a piece of real estate in it, and the life tenant borrows money from the bank and pays cash to the remainderment, and therefore she just has that land, that real estate. So that seems to be relatively clean. What happens if, on the other hand, you have a marketable securities portfolio and the surviving spouse borrows money from the bank and uses that to buy out the remainderment, and the next day she cashes in sells some marketable securities and uses that to pay off the loan? Well, you can imagine that the IRS might try to argue that that's a step transaction. She really used her interest in the trust to buy out the remainderment, and so that was really a commutation of the trust. So, kind of take a look if you're going to do this life tenant buying out the remainderment. I don't know when step transaction would apply to this. I don't even know if it's legitimate use of the step transaction doctrine. So I don't really know any of this. I don't know of any cases on it in particular. There probably are some, but I haven't really tried to study and analyze. But I'm just saying that if you do this life tenant purchase the remainderment, then try to look at the substance of what you're doing and make sure that the form and the substance match and see what you can do to avoid the step transaction. The IRS might say no matter what you do that they're gonna call it a sale of the life interest. And we'll talk about other form of substance issues in a little bit. But kind of the bottom line is watch out for the way you do it. All right, next slide. So there's a letter ruling in 2019, or actually a series of rulings, that there was a court-approved agreement for the trustee to distribute the trust. So basically, the beneficiaries, it wasn't the beneficiaries didn't say, "Hey, I'm selling my interest to you." What they did is the trustee made a distribution to cash out each beneficiary. And the trustee did that under the cover of a court-approved agreement that said that the trustee could do that. Now, in that trust, there was mandatory income to the life tenant, and there were no provisions for principal distributions. So it's kind of hard to just say that the trustee just distributed the beneficial interests as they were to the people, because there was a change in their interests. So this was a commutation. The ruling itself was fairly poorly reasoned in terms of what the ruling cited, and it kind of talked about some people were selling and other people weren't. I'm not quite sure what's correct in terms of who should have been selling or not, but I do agree that there was a commutation there, and I do know some other very smart people who would say that it isn't. They would say that 1.1001-8 totally protects it, and just forget it, and it was wrong. So, but I'll get into why I don't necessarily agree with them. And then again, that ruling said the sale of beneficial interest was a capital gain. There's nothing new there. Next slide. If the under the Internal Revenue Code, the life tenant can use the basis if the sale is part of a transaction in which the entire interest in property is transferred to any person or persons. And the regulations narrow this by requiring a transfer to a third person or two or more other persons. So in 1001E3, if the life tenant sold to the remainderman, that would be okay, and the life tenant would be able to get basis for that, because if the entire interest in property were transferred. Now, may not be okay, because are you transferring the entire interest in the property? The remainderman already owns part of the property, so are you really transferring the entire interest? So I'm not totally sure whether a sale to remainderman would do the trick or not, but I'll get into the policy reasons in a moment. But the regulation requires it to be transferred to a third person. So they're saying you sell it to remainderman, forget it. You don't get that treatment, so you don't get the basis. Next slide. Now, one of the issues behind this is if you buy a life interest, are you allowed to amortize it? And there's some cases where people went and they bought a life interest and they amortized the life interest, so they never had to pay income tax on the income that the trust generated, because they got to amortize the life interest and take those amortization deductions against the income. And the IRS is kind of like, whoa, that's not fair. That nobody's paying any income tax on this income. So Code Section 273 says you can't do that. If it's acquired by gift, bequest, or inheritance. Now, there's a review ruling that does say you can amortize a purchased life estate, but there's an exception that says that if you have a remainder interest that's held by a related person, then you are not allowed to amortize it. So the only time that you can amortize it is if the life interest is sold to a third party. Next slide. Now, there's a letter ruling that quoted legislative history and said that we're not going to take away the life tenant's basis if the trust is terminating by this, because then there's no life interest left to amortize, and the whole point to the code section was to prevent you from being able to amortize it. And I'm sorry, was to prevent you from getting basis and then letting the person turn around and amortize it. In that particular letter ruling, the purchase was by a contingent remainderman. Going to the next slide. So the policy would suggest that any purchase that terminates the trust would prevent that would preclude amortization would allow you to use your life tenant, let the life tenant use basis. But that policy doesn't, unfortunately, apply in the regulations. Next slide. So now let's go on. So we have a clash between 1.1001-H, which could be broadly construed to protect most commutations, so that you never tax a commutation as long as you have a distribution by the trustee and a non-pro rata distribution is authorized. So that 2019 letter ruling that I told you a lot of people criticized, that arguably that would be protected by the regulation. On the other hand, we have a regulation that says it assumes a commutation is taxable, and we have a lot of law on that. So what do you do with these conflicting regulations? Next slide. So we have a different regulation, 1.1002-1B, that has strict construction of exceptions from the rule. And of course, you can't read the slide as presented there, but hopefully you can print it out and look. And what that says is that they will strictly construe any exception to recognition. So if you're going to do a sale or exchange and the taxpayer argues that there's an exception to having a tax, then we're going to strictly construe that. So the next slide. So that means that when we look into this conflict between 1.1001-H protecting trust divisions and the law on commutation, we have to make sure that this that whatever we're doing is clearly within the rules, the whole spirit and everything of the rule protecting trust divisions. So then my question kind of is, are you really changing a beneficial interest? And so, and then kind of how do you say you're changing a beneficial interest? Well, is a beneficial interest an entitlement with a measurable expectation of financial benefits? Next slide. So an income interest or its equivalent can be measured. Ascertainable standards tend to constitute a measurable economic interest. But let's suppose we have a beneficiary who's entitled to distributions for support, but the trustee every year says, you have enough money as it is, you don't need a distribution, I'm not giving you a dime. And year after year, the beneficiary gets no distribution. So even though that was an ascertainable standard, they got no distributions. So arguably, that interest has a nominal value, maybe even a zero value. And you can see that I have discussions on those types of issues in Part 3B1B. Next slide. I mentioned before that transferring an entire beneficial interest to a new trust can trigger Code Section 2702. So that's I already mentioned that, and so kind of the details are in this particular provision, cross-referenced here. Now, if you have a trust division and the original trust contingent is intact, property goes to a new trust, you're limiting the gift tax consequence because it's only the part that got split off that is changed. So you may want to consider doing that. Next slide. So if you have a trust with multiple beneficiaries and divide it into separate trusts for each beneficiary, then that's probably not going to be considered to be any kind of a gift or an income taxable exchange. When is a change in expected series of distributions material? Let's go on to the next slide. Although not directly on point, I would look to maybe the modification of debt instruments, because debt is a fixed series of payments. So if you have something, a trust interest that say there's like a fixed series of payments, when is there a material change to that? I might analogize to the debt. There's no law that says you could do that. What I'm saying is there's no really law that you can really rely on to quantify this stuff. And so I'm just trying to draw an analogy, and maybe you can look somewhere else so you can draw an analogy too. We're grasping at straws here, but at least you can maybe look at something analogous. Now, the second bullet point in that phrase, in that page, says that modifying a mandatory income trust to allow the trustees to accumulate income, well, that seems to me like you're reducing the beneficial interest in that they don't get it. The income beneficiary doesn't get it, but it's going to the beneficiary's estate. And so that ruling said, hey, the beneficiary is getting it sooner or later. There's no consequences to that. That's not really a significant enough change. All right, next slide. If the trust is purely discretionary and the remainder men are also current beneficiaries, then arguably nobody has any measurable interest, and so you may very well be able to just to cash people out, divide it up, without any income tax or gift tax consequences, and then you just kind of need to look to see, okay, where is it? Is it closer to this purely discretionary, like I'm positing here, where I would say very strongly that 1.1001-1H would apply and protect it, or are you more like having a clear and measurable interest? Where are you on the continuum? That's up to your judgment. Let's go on to the next slide. Okay, now we're going to move on to a total brand new topic here, and this is this concept of negative basis. Now, the idea of negative basis is jargon that people use, and it's really a technically incorrect description, but it gets the point across. It's a shorthand description for a certain situation where the basis of a partnership interest is zero before you consider liabilities, and the partner's basis in the liabilities that they're allocated is less than the face amount of those liabilities. Let's go on to the next slide. And the idea here is that whenever you have a share of the liabilities, whenever you're allocated a share of liabilities, you are deemed to have put money into the partnership. And whenever your share of liabilities is reduced, you're deemed to have received money from the partnership. And so a change in your allocation of liabilities is a deemed contribution to or distribution from the partnership. Next slide. If you contribute property subject to a liability, then that's kind of the same thing as the partnership that assuming your liability. So you used to have the liability, you don't have it anymore. Now it's going into the partnership. Now that's in the partnership, the question is, do you get allocated that liability back so that your liabilities really haven't decreased? Or does that liability get shared with the other partners so that your liabilities have been decreased and you're deemed to have received something? Well, we don't necessarily want to be deemed to have received something because then maybe you've kind of had a sale. And so usually you try to set it up so that you're deemed to retain that liability under the partnership rules. So let's go on to the next slide. There's rules for what is a liability. There's rules for allocating liabilities depending on whether they're recourse or non-recourse, and I'll let you read up on those. Next slide. There's some final regs that change the rules for determining when you have economic risk of loss and therefore how you allocate liabilities. And you can see I have a slide where that's described, and there's some very well-regarded partnership income tax lawyers who don't like what these regulations said, and they're very critical of them. So you can take a look at the criticism, you can look at the regulation, do what you want with it if you're doing some kind of a calculation. Next slide. But I would just be wary that you do have new regulations, so anybody who has debt-laden partnerships, they ought to be taking a look at that when they're working on partnership tax returns, or when they're not even whether they're even. I mean, the CPA should do when they look at the partnership returns, but lawyers might want to talk to the CPAs and just say, "Hey, CPA, have you addressed these new rules? And when you've done this, are there any consequences? Is there anything we can do to help protect that?" You can amend your partnership agreement before the partnership return is due. The original due date of the partnership return, you can definitely do that. And so right now would be a good time to go back and look to see whether there's any tax consequences to that and whether any kind of amendment to the partnership agreement can help that out. The other thing is that in addition to these regulations attacking this situation, the IRS is now starting to look for information where it could maybe audit this. There's what the IRS is saying, that we want to look to see what your so-called tax basis is. And if your tax basis, of course, has liabilities in excess of basis, then there may, that might be a trigger for audit. They didn't say they're auditing it, but that's a logical conclusion to why they're doing that. Next slide. So 2018, they started asking for this information. A lot of people had a hard time complying with it. There's some relief that the IRS gave for 2018 returns. Next slide. And now we have some more detailed instructions for 2019 reporting. So you're going to need to report this on 2019 returns, and now there's some detailed rules. I'm not going to go over those. I don't want to bore the people who are not into partnership income tax. I just want to alert you to the issue. Okay, next slide. So when does this issue occur? If a partnership borrows money, distributes the loan proceeds. So now the partnership has liabilities, but the cash got distributed out. So the partner got basis for the debt that the partner got allocated, but the partner used that basis when he got the distributions. So now there's no basis in the partnership, but there are liabilities in the partnership, and if those liabilities decrease for any reason, that's a deemed distribution to the partner, and if that's in excess of basis, then there's a tax situation. And so if you had, for example, if your share of the liabilities was $100,000, you receive that $100,000 of cash, you have a zero basis. Now 10 years later, you go and sell that partnership interest, it still has that zero basis with that $100,000 debt. You go and sell that, you are deemed to have a sale price of $100,000 plus whatever you receive. So let's suppose the property is almost worthless. You sell it for $100. So that's the cash you actually received. Well, you're deemed to have received $100,100 when you do that sale. So you have what we call, phantom income. Now, actually, that's perfectly fair because you already received $100,000 in an earlier year. So you got that $100,000. You're just not getting taxed on it till now. So what people would want to do when they have a situation like that is to hold the property until they die. And then they will get a basis step up. And let's go on to the next slide. And they will be able to purge the negative income tax effects. They'll get basis for that $100,000 of liability that got reduced before. They're going to get the basis at death. So you want to, I really do like the idea of equity stripping. In my example of taking that $100,000 out, you had the $100,000 that you can give to your beneficiaries. They get a $100,000 basis in it. Suppose you have a partnership that has real estate in it, and that real estate has been depreciated down to practically nothing. It's got a huge value. You don't want to give that away because there's no basis in it. If you strip out the equity by taking a loan against the value, you give away the equity, that's basis. That's cash, that's basis. You keep that property that has a significant value, and you keep it till your death. You die holding that property. Now you have a basis step up to the full value of the property. You don't have to pick up that $100,000 in income. So that's a very beneficial thing to do. And there are also some ways to use borrowing like this to shift basis. I'm not going to go into detail here, but my materials go into that detail so you can read them. Okay. The other thing is that if you make a gift of your entire interest in a partnership, then you're deemed to have been relieved of the liabilities, and that can trigger income tax. So what you might want to do if you have all these huge liabilities, keep a little sliver of that partnership. Make sure that you have economic risk of loss with respect to that to the liabilities. Then you don't have a triggering of that gain because you're still a partner. If you're no longer a partner, then you got to pick up the gain. If you remain a partner, you can get the liabilities allocated to you if you do things the correct way, and then you can just hold that till death. Okay, next slide. All right, now we are done with that. I know I raced through that, but I wanted to kind of get back on time for this transfer for value rule slide. This is a very important topic. So normally, when you receive death benefits from a life insurance policy, that is not subject to income tax. However, if you make a transfer for valuable consideration, then you may lose that benefit of being protected from income tax. So you make this transfer for value, and that may cause your death benefit to be income taxable. Now, there are two exceptions to this rule. If you have a transfer for value and it's a substituted basis transfer or a transfer to a permitted transferee, then you're okay. You still get to protect the death benefit from income taxation. That's the general rule that we've had for many, many years until the end of 2017. Now, before I go into more description of what these old rules are and what the new rules are, starting in 2017, I just want to point out, because I've been asked this question many times, what if you have a transfer like a sale to an irrevocable grantor trust? You're receiving value back because you're doing a sale. But for income tax purposes, that's not considered to be a transfer because you're the deemed owner of that trust. And so we have a revenue ruling that says you looked at the deemed owner of the grantor trust to decide whether there's been a transfer for value. Okay, next slide. Now, what will trigger a transfer for value? Until 2017, the regulations said that any value will do. And there's a letter ruling that says that just entering into a buy-sell agreement means that whatever transfers you do of life insurance in connection with that buy-sell agreement are a transfer for value. So the buy-sell agreement, just you didn't have no money you swapped hands, it was just a buy-sell agreement. That made it that triggered a transfer for value. Well, when the tax law changed in 2017, and we'll get into what that change was in a moment, the government decided to do a top-to-bottom revisiting of the transfer for value rules, and the IRS decided to give us a more taxpayer-friendly rule. And now it says that a transfer for value is a transfer of the contract for cash or other consideration reducible to a money value. So that buy-sell argument or that 77 letter ruling, forget it. That's gone. That's out. Now, what's a transfer for other consideration? If you transfer to a partnership, we have an example that treats it as a non-taxable exchange. We also have another example that assumes that a contribution to a corporation in a non-taxable exchange is also a transfer for valuable consideration. So if you have any kind of a transfer for the policy that may be considered to be an exchange, even if it's a non-taxable exchange, it still is considered to be a transfer for value. As long as you get something back, it doesn't matter whether it's non-taxable or not, the fact that you got something back, some very valuable property right back, that is going to trigger that. Next slide. Now, I talked before that under the old rules, there were two types of transfers that got you out of the transfer for value rule. One of them is what I call a permitted transfer, and another word for that is a substituted basis transfer. And you can see the literal language for that. But examples of that are a gift, a transfer to a partnership, or a swap of life insurance policies. Those transfers are substituted basis transfers. Those under the old rules were protected from the transfer for value rules. Next slide. The other is if it's not a permitted transfer, maybe it's a transfer to permitted transferee. And you see the list there of people who are permitted transferees. Next slide. 2017 tax reform did two things relating to life insurance. One was that it clarified the rules on the basis of the life insurance policy, and there was a revenue ruling that took an unfavorable position to taxpayers on that, and most lawyers didn't think that had basis, and the Congress retroactively did away with that aspect of that revenue ruling. The other thing that it did is it introduced the idea of a reportable policy sale. And what that said is, all right, you had these transfer for value rules, and we had the exceptions. A transfer to a permitted transferee, or maybe it was a permitted transfer. So what the new reportable policy sale says is that if you have a transfer for value, then those two exceptions I mentioned will not protect you if the person who receives the policy is a stranger. And we're going to talk about what that means in a moment. And if that person who receives the policy is a stranger, that's a reportable policy sale. Being a reportable policy sale has two consequences. One is you lose the protection of having a permitted transfer or a permitted transferee. The other is that you have to report the sale. Okay, next slide. I just kind of mentioned what the consequence was. Now, notice that what I said is, if it's a reportable policy sale, then the exceptions to the transfer for value rule do not apply. I didn't say that any time it's a reportable policy sale, you have a transfer for value. I didn't say that. I said, if you have a transfer for value, then the reportable policy sale rule prevents those exceptions from protecting you. So that's a very subtle distinction, but it's an important one. Next slide. All right, what is a reportable policy sale? So you can see here on the slide the definition. It's an acquisition of an interest in the policy, directly or indirectly, if the acquirer has no substantial family, business, or financial relationship with the insured other than the acquirer's interest in the life insurance contract. So before the transfer occurred, the person who acquired the contract had to have a substantial family, business, or financial relationship. Now, this indirectly means if you become a beneficial owner of a partnership, trust, or other entity, then you may have an indirect acquisition, so it's a reportable policy sale. Okay, and then we have regulations that describe the relationships and we'll go through those very briefly, and then we're going to circle back to this indirectly issue. Because my point is, the indirectly may make it be a reportable policy sale, but it might not have transfer of value implications. We'll get into that in a moment, in a little bit. All right, let's go on to the next slide. Who is a family member? You can see this slide here depicts who a family member is. You can read that yourself. I'm going to go on to the next slide. Again, more people who are family members. You can read those yourself. I'm going to go on some more. What is a substantial business relationship? Basically, the insured is a key person in a business that is owned by the acquirer. Owned in part, owned in full. And there's definitions to key person. So I'm not going to go into all the nuances here, but the idea is that the insured here is going to be just mainly a key employee, somebody who's essential to running the business. And if you have a key employee and they die, that's going to hurt the value of the business. So that's going to hurt that business owner. So if the person who owns an interest in the business would get hurt by that person dying, then you can see they kind of have a legitimate interest in that person's life. And so if the person would get hurt by that person dying, the idea is then they're not a stranger to that person. They can get an interest in the policy, and it's not a reportable policy sale. That's kind of the policy idea. I will leave the technical details of what that means, how that's implemented under the technical rules to your reading. So we have a slide here. Let's go to the next slide. That goes into more details on having that kind of a relationship. What type of relationship counts as somebody who's going to get hurt by that person's death. Let's go on to the next slide. And let's keep on going. Okay, the next one is a substantial financial relationship. So, does that person's death cut you off from something or cause you some kind of obligation? That's the general idea between the substantial financial relationship. And we'll go through this for a moment. So, if you have a common investment with the insured and you take out a policy on the insured, or somebody transfers a policy to you, okay, you have to buy out that insured when they die, so you need the policy. You have some important reasons for needing that policy. You have a relationship with the insured because you have to buy them out when they die. Actually, you're buying out their estate. You're not buying them out. They're buried. Okay, so you have the common investment, the buy-sell obligation. You have a substantial financial relationship. Next slide. Another is that there's some liabilities that arise by reason of the death of the insured. So let's suppose you have, let's suppose that our friendly neighborhood bank loans money to the business, and the friendly neighborhood bank knows that that business is going to lose a lot of value if the insured dies, and they might not be able to pay off the loan. So it makes sense that there's going to be a potential financial harm to this lender if the insured dies. And so if somehow a policy makes its way to the lender, that's not going to be a reportable policy sale because this life insurance is helping to pay off that loan. That's an existing relationship. Also, we kind of talked about funding the purchase of the insured's business interest. And so maybe you don't have a common investment necessarily, but there's still some kind of obligation to buy out the insured. So that's another reason you'd have a substantial financial relationship. Next slide. The other thing is a charity. And when does a charity have this type of relationship? My initial reaction to all this stuff on charity was like, come on, charity is really an estate planning idea. And I would kind of view charity as kind of like family. You leave money to them because you feel good toward them. They're in your estate plan. They may not be the natural object of your bounty in terms of being your blood relatives, but you have warm and fuzzy feelings toward them. You want to benefit them. They're part of your estate planning. It's very common to leave money to charity. So I kind of viewed a charity be kind of more like family. But they aren't literally related to you, and they're not spouses of people who are related to you, so they're not family. They're coming in under the substantial financial relationship. So if the person who acquires a policy, if the charity previously received from the insured either financial support or a substantial amount of volunteer support. You volunteered to be their CFO. You provided very valuable services for them. If you die, you're no longer able to provide those services. They need to replace those services. So they have a loss. They have a substantial financial loss when you die because you're not going to be doing that work for them anymore for free. They're going to have to hire somebody for it. So that's the idea. If you gave them an annual gift and you die, boom, that gift stops. We'll let you fund the continuation of that gift. That's a substantial financial relationship. So the volunteer support, the substantial volunteer support, the substantial financial support. How much is substantial? I don't know. This is another one of those areas which I've said in many webinars. It's like the U.S. Supreme Court's definition of pornography. I know it when I see it. Now, I also gave another example. I've done some volunteer work for Jewish Family Services, and they help a lot of people who they may kind of be down and out. They're down in the luck now. They help them with counseling. They may help them with a little bit of financial assistance. They help them get on their own 2 feet, and then they can get off and running and maybe live their life normally. Then when that person dies, they want to recognize Jewish Family Services and their estate plan. And many times, Jewish Family Services has gotten requests from people who it had helped before, or maybe they might have been related to somebody who got helped. But the people who they helped, let's look at the big picture. They were going through rough times. They got themselves righted. They saved enough for retirement, but they didn't necessarily strike it rich. So maybe they felt that they were unable to financially contribute to Jewish Family Services, and there's a lot of people who've done that. They don't, during their life, contribute substantially to Jewish Family Services because they just don't feel they can spare the money. They need it. They're living paycheck to paycheck. But part of what they saved up at their death, they're willing to give back, and so they bequeath to it. So I gave this example. I said, what about those people? If they want to do something with a life insurance policy, let's let them do that and not have it be a reportable policy sale. And the government said, now you're getting into something it's really hard to tell. What do they do for them? What did Jewish Family Services do for them so many years ago? What kind of relationship they have is so tenuous. They said, we aren't going to provide exceptions to regulations, but we'll throw you a bone. If your charities want to go and figure out what they think the test should be, they can write in to the government and ask the government to provide additional guidance and provide an exception for them. And so if any charities do want to do the work of getting an exception, they can do that. I doubt any will, but it's there. Next slide. All right. Now let's go into special rules. We know who's a stranger under these reportable policy sale rules. Let's go back to these rules for indirect acquisitions. So if you have an indirect acquisition of a life insurance policy, so for example, there's a partnership that has a life insurance policy, and you get an interest in that partnership, so you've kind of indirectly gotten an interest in that life insurance policy. Well, you might not yourself personally have a connection to the insured, but that partnership may very well have a substantial business or financial relationship with the insured. So if the partnership has the connection, then and you're only getting deemed to have had the interest in the policy through the partnership, then you're deemed to have that connection too. You'll see there's a bunch of technical rules on that. That's just the general idea. I will leave it to you to go to the technical rules in case I didn't say it exactly perfectly. I just want to give you the gist of it. Next slide. There's just more rules on these indirect issues and how you might be deemed to have these substantial family business or financial relationships. I'll leave that to you to go through that. Next slide. What's a beneficial owner? So a beneficial owner could be, again, an owner of an entity that owns an interest in life insurance policy. Next slide. There's some rules on trusts as creating beneficial ownership, and I'm just gonna leave that to your reading. Next slide. There's certain transfer if you have related entities and the transfer of the policy goes back and forth between those entities, and they kind of have common ownership, then they'll provide an exception and say, well, that's not really counted as a reportable policy sale. So if there's transfer between related entities and they kind of have kind of same ownership anyway, then they won't tag you with the reportable policy sale. And again, you can go and look at the details. Next slide. So the final regulations talked about what happens if you have a swap of a life insurance policy. Now, again, under Code Section 1035, if I have a policy on Irene and I swap it for another policy on the life of Irene, then that is considered to be a non-taxable exchange. And so I'm not going to have to report any income tax on that transfer of that policy. Now, I do have an exchange, though. I'm swapping in a policy for another. There's an exchange. So we need a test to see whether that is, and so that is a transfer for valuable consideration. So then we need to test to see, is that a reportable policy sale? And there are really two transfers going on here. I am transferring a policy to the life insurance company, and the life insurance company is transferring a policy back to me. Now, when I transfer that policy to the life insurance company, the transfer for value rules are not going to apply to the life insurance company. Again, it's a substitute basis, and they do have a relationship with her. They have a direct relationship. They're insuring her life, for crying out loud. Now, what about the new policy that I get? Well, I have to have a policy. I have to have an interest in Irene's life, a relationship with Irene at that time. Now, let's suppose that my name instead were Walmart, and Irene was my employee when I got the policy. I have a substantial interest. I have a substantial relationship with her because she's my employee. Now, let's suppose that I have an unqualified deferred compensation plan, and I want to use the life insurance to fund the retirement payments to Irene. Now, while I hold this initial policy, I can receive non-taxable distributions from the policy up to the extent of my basis, and I can receive the death benefit income tax-free too, so that's a nice benefit that I can receive the death benefit too. But I'm using that to pay off her retiree benefits. Now, when the policy was issued, I had that interest in Irene's life. Now, what happens if Irene becomes a retiree? She's a former employee, and I still have to pay her deferred comp, but if she dies, then I don't have a risk of loss. I didn't have any kind of obligation to pay her anything at death, and in fact, if Irene dies, I don't have to pay her deferred comp anymore. So I actually, and I'm sorry to say this, I really am, but if she dies, I kind of come out ahead because I don't have to pay her anymore, and I've got this policy. If she's a retiree at this time, and I decide to swap in the policy for a better performing policy, that new policy is going to be a reportable policy sale. It's going to be tainted because I no longer have an interest in her life, and even though it was a non-taxable transaction, it was still a transfer of valuable consideration, and she didn't have. I didn't have a loss by reason of her death. I didn't have kind of the reason to have this connection with her. So that's something to watch out for if you have a client who's an employer who has non-deferred qualified deferred compensation, and they fund it with life insurance. You got to watch out on those policy swaps. Next slide. Okay. Now let's go back to the old transfer for value rules. If you had a policy that got tainted under the old transfer for value rules, then you are, you have ways to avoid them. But let's suppose it gets tainted under the rules. Let's go on to the next slide. Oh, I'm sorry. Go back. When it's not a reportable policy sale and the policy was not tainted by a prior reportable policy sale, you can cleanse a tainted policy. So I do a transfer to David. I sell my policy to David. Okay, so it's not a substituted basis policy. David is not one of those permitted transferees. I've done a reportable policy. It's not a reportable policy sale because maybe I have a connection with David. I have a connection with David that makes him not be a stranger, but he's not one of those permitted transferees. So it's not a reportable policy sale, but it's tainted under transfer of value rules. If David transfers a policy back to me or back to somebody who is a permitted transferee, that will cleanse the policy. The old law said you had to have a transfer for value back to a permitted transferee, and that person had to hold on to that policy at death, and it had to be a transfer for value back to that permitted transferee. I wrote a comment letter to the IRS and said, look, why does it have to be the last transfer? Why can't that just cleanse the policy? And they said, you're right. We're going to let it cleanse the policy. And I said, why does it have to be a transfer for value? And they said, you know what? If it's back to the insured, we're going to let a gratuitous transfer count. So they eased up on the prior rules in response to my comment letter. So I wanted to let you know about that easing up in the prior rules. Next slide. If you have a prior reportable policy sale, then you're tainted forever, and the statute gives no exception whatsoever. I wrote a comment letter to the government, said, please, pretty please, with sugar on it. People make mistakes in estate planning all the time. Maybe if they sold to a life settlement company, and then they started having trouble sleeping at night because they realized that a third party had an interest in the early demise, and they got really nervous about it. They bought it back. You know the life settlement company is going to want to take a profit on it. You know, if they pay full fair market value, please remove the taint. And they said, okay, we'll remove the taint. And there's some special rules about how that works. All right, let's keep on going on the slides. Keep on going. 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 Again. So if you have an indirect transfer, if you transfer an interest in a partnership that owns a life insurance policy, the pre-2018 law said if you transfer that partnership interest, that is not a transfer for value. So it may be an indirect transfer that triggers reporting under the reportable policy sale rules, but the transfer in that partnership interest is not a transfer for value. I don't think it is, and therefore the reportable policy sale rules will not taint that policy. You have a reporting requirement, but they won't taint that policy. I think that that's the better rule. I think that's correct. People in the life insurance industry, I've heard, also believe that's correct. But just in case it's not, if you report that indirect policy under the reportable policy sale reporting rules, then that will be an exception, and it will allow you to have safety that this indirect transfer didn't count. Okay, let's go on and keep going. Again, some more, until we get to 101J. Keep on going. Keep on going. Keep on going. Going. Keep on. Okay, we're going through all these various examples that you can all look at your leisure. Keep on going. And now I just want to point out that if you have buy-sell life insurance policy, even though that's not a reportable policy sale, there are some notice and consent requirements. Those are in my slide. They're in a prior webinar. And so now let's go on all the way to the end, to slide 105, because this is going to the end of the webinar. I've run out of time. I hope you've found value in this. I'm going to be doing a webinar with my partner Laura Duncan on fiduciary income tax refresher for an hour and a half. I invite you to attend that. I invite anybody who doesn't have my blog. I have a blog for lay people that you can sign up to as well. Reports on heckling. The Heckling Institute just was done. There's the ABA Ripley does some reports on that, and I comment on those reports. And I have about 15 different things reporting on those reports, and as well as those reports themselves. So you can sign up for that and find out about what went on heckling if you didn't attend. And then of course I invite you to sign up for my newsletter if you don't already do that. Well, gee, I didn't put in the right slide here. I do have at the end of April will be my next webinar. My newsletter has a link to an hour-and-a-half webinar on the transfer for value rules under the new regs. So if you didn't get enough of those in the half hour, you can look at my newsletter and go to the Lineberg webinar and buy that. So that's it for now. I hope you've enjoyed it, and I'm sorry I ran over. Look forward to talking with you February 12th or the next quarter. Please be sure to complete and submit the survey that we'll display at the conclusion of the webinar. Thank you.